Hi there, this is Rick Kelo, and I am making this video to tell you about a really cool technical journal article, and it answers a political question that comes up all the time. You'll have, the way the political topic goes is you'll have someone on the right, American politics, who will go, corporate tax rates are too high, and that is causing companies to be uncompetitive and to move to other countries. And they'll say, there's Burger King inverted to Canada as an example. And then the debate on the other side, folks on the left will say, they're not too high. It is true that you have this ranking, and it shows that compared to the OECD countries, the tax rate is really high in America, but that's the marginal tax rate. That's not what they really pay. Our corporations have lots of loopholes, and their taxes are lower, and so it's not the case that we're high relative to other countries. And so that's where it stops, because then no one knows what's the effective tax rate, is what we call it. What are businesses actually paying versus what is the highest possible rate on paper they may pay before deductions. And so that's what I'm going to give you the answer to over 82 different countries and where the US ranks. So before I do that, from an economic theory standpoint, what's really neat about this topic is that we would expect it to be the case that it would average out. So we would think that, a firm that's in a line of production, a type of industry that's taxed very high in one jurisdiction, they're going to respond to that incentive and they're going to move. Now, there are transaction costs, of course, that, are incorporated in there, but we would think over the long sweep of time, they would work out that way. So if new businesses are going to organize, they're more likely to organize in a jurisdiction where they are, in their line of business, are taxed lower than in, say, a jurisdiction where they'd be taxed higher. All right, and that's not at all what we see. All right, so there's some interesting piece of it there. The other piece to consider is, from an economic theory standpoint, we expect that businesses that are multinational, so they do business in other countries, are going to have a big competitive advantage over domestic businesses because they will have more ways to lower their taxes. I mean, they can set up, they can do some transfer pricing, they can set up a entity that is a corporation in one jurisdiction and it's a pass-through in another. They can repatriate their earnings, their foreign earnings, at a time when it's most tax advantaged to move the cash back to their home country. What else? They can strip profits from one company, and move it, through intercompany financing over to another. So there are all these different mechanisms, whereas if you're a domestic company, you're stuck. I mean, you don't have those available. And so anyway, all right, so from the first place, we'd expect multinationals to have an advantage. And that's going to translate to a market advantage over time. All right, so the study is Markle and Shackelford, 2011. I'm going to tell you exactly where they found the U.S. to rank. What they did was they looked at about 30,000 corporate financial statements over 82 countries. They did a big regression and they said, hey, now let's rank everyone on what firms are actually paying, their effective tax rate, it's called, and who's the highest country, who's the lowest, and then where does the U.S. fall. All right, so what they found was the highest was Japan. If you are a multinational in Japan, you are paying, a corporation, you're paying a 37% tax rate, effective tax rate. That is so crushingly high. The second highest, though, it is the case that the second highest is the United States. In terms of effective tax rate, our multinationals average 30%. The third place is actually a three-way tie between South Africa, Australia, and the United Kingdom at 26%. Which actually, if you come to think of it, is not surprising because you've heard a lot in the news lately about multinationals in the UK considering inverting out. So that's maybe not a surprising response to that effective tax rate. So a couple other things they found that are really neat, one of them especially was that effective tax rates are going down. Over the long sweep of time, they are lower now to a statistically significant level than they have been in the past. And then the other finding, which is not terribly surprising, but they also found it depends on your industry, obviously. Retailers were the highest. Construction firms were the second highest. I was surprised by the lowest, which was mining. I didn't expect that to be the case. And then who was the second lowest? I believe it was information firms is how they called it. And they didn't specify whether that meant a service industry like a consulting firm or if that meant IT firms that manufacture say a semiconductor or something along those lines. Anyway, so that was the principal finding. Markle and Shackelford. Shackelford is the dean of Keenan Flagler Business School. Markle is at Tuck at Dartmouth. So they're both at top 20, they're both professors at top 20 MBA programs. Very detailed study. I hope you've enjoyed hearing the findings. And now the next time the debate comes up of, well, is America high relative to other countries? Oh, we don't know because we can only look at the marginal tax rate on paper, but that's not what everyone's really paying. Well, now you know how we compare on the effective tax rate that our firms are actually paying. Again, this has been Rick Kelo, and thank you for listening.